I'm Keith McCullough. Welcome back to our studio here in Stamford. Today I want to talk about what everybody's talking about today, which is the jobs report. Now the problem with the jobs report is that the media typically doesn't get it. So what they do is they focus on the moment. It's the manic media, the point that they're trying to get to. They don't even know. What I'm trying to get to here, and I think the entire investment community tries to get to, which is what is happening from a trend perspective. What is happening from an intermediate to long-term perspective? What does this look like within the context of 10, 20, 65 years? So that's what I want to do. I want to go through three charts that contextualize that intermediate to long-term trend that people are focused on. So the first thing that I want to look at, which is a mouthful, the labor force participation rate. Now, people will whine about this being at 63.2% this morning, but guess what? That is on the lows for a reason. There's a big demographic tailwind that's reversed here that is secular. That's ongoing. People are getting older. So again, less people participate. If you go back to the top of this chart, the all-time high, by the way, in the labor force participation rate was at the end of an economic cycle. So at the year 2000, this peaked out at 67.3%. So again, these things peak at the end of a cycle. They aren't high at the beginning of a cycle. So if you believe that the economy is turning, we're at the beginning of a cycle. That's why we're at 63%. We could easily go back to 63, 64, 65%. I don't think that's a huge problem. Second point, U6. Now, U6, what the hell is U6? People are like, yo, this is an unemployment situation. It's a disaster, yo. I mean, what am I going to do? Jesse Pinkman, his whole barge of friends, the most dysfunctional part of this economy, gets upset when U6 is peaking. Guess when U6 peaked? When the U.S. deficit to GDP was tracking closer to 10%, this economy was in turmoil, and that number was 17.1% in April of 2010. So we've improved from the nastiest of all nasty rates. The U6 rate is now down to 13.6%, a distinctive improvement versus the fear-mongering that you hear out there in the media. Now, thirdly, the point that I want to make on this third chart is consumer confidence. Now, how do you talk about the jobs market without considering behavioral economics? People's confidence matters. Look at this chart. Confidence is well off the lows, which occurred in 2010, 2011. The green line reflects that. As confidence rises, people are apt to quit their job. Guess who would quit their job? People who don't like working for the man. People who are not happy. Why would you quit your job? Because you think you can get another job. So again, the job improvement has been tangible, and I think that that's the big lesson of 2013. The jobs picture is a lot better than the political partisanship would have you believe. It's a lot better than the bond bulls thought. It's a lot better than the gold bulls thought. The stock market's at an all-time high today. Again, the jobs picture is nowhere near as dire as the popular press would have presented it. So with that, I want to just give you an opportunity to take some time and give me some questions at my Hedgeye handle, which is @Keith McCullough. Any compliments or concerns, would love to hear from you anytime during the day. Thanks.